All right, so the recording should have started. Now if you go back to the drive, if you go back to the Google Drive on the description in the description of the group, you would see that I already updated it and added the lot size documents there, and also back to the course that we were using. So back to the course that we were using. So I explained I I explained I explained what the PIP was last week. I explained a couple of things last week. What is trading? How do you make money trading? Who are the big players in the trading industry? You know, digital trading, Forex. I talked about a bunch of those stuff. And yeah, what are currency pairs? How exactly do I make money? What are trading sessions, relevant applications, and then PIP. And PIP was like, okay, getting into the technicality of the whole trading thing, right? So, and I remember saying that PIP is the smallest unit of price movement, right? That PIP is the smallest unit. And I also said that the PIP is the fourth decimal number. The PIP is the fourth decimal number. So whatever movement that happens there happens by pips, right? Okay. So you guys like can be, if you're following, just you can just be reacting. Okay, very good. I just want to know that people can hear me because I did not allow for people to turn on their audio so it doesn't distract me. So yeah, now then we go to oh, sorry about that. Then we go to another complex concept. It's not exactly complex. It's not supposed to be complex. Another complex concept or a bit complex concept is lot size in trading, right? What are lot sizes? How do you understand lot sizes? How do you explain lot sizes? Things like that. And what is the effect of a lot size? What does the lot size do? What does the lot size do, right? So what does the lot size do? Yeah. So what's the lot size in Forex? Lot size is one of the most important things in Forex trading, right? It determines how much money you make or lose, where price is in your favor or against you. So when you are trading, right, in the act of trading, in the activeness of trading, when people say you enter a trade and you are making money or you are losing money, what determines how much you lose and how much you make? That's the lot size. And today I'm going to have a very interesting. I might stay a lot with this topic because the topic is very relevant when it comes to a lot of misconceptions as regards trading and how exactly we um and how exactly we reshape those misconceptions or refute rather those misconceptions, right? So how you make money or how you lose money depends on the lot size that you're using, right? As regards the account size or whatever. So now that you have a proper understanding of pips, right? I wrote this example there. Let's say you have a $10,000 account, right? You have a $10,000 account, and you are entering this. In, you are entering a sell trade on the Euro USD, which is the pair that I trade, and your stop loss is 20 pips, right? And your take profit is 40 pips. right? So okay, so if your stop loss is 20 pips and your take profit is 40 pips, right? That means your risk to reward, just deviating a bit from lot size. Your risk to reward is ratio 1 to 2. That means what is the ratio of your stop loss to your take profit, right? If your stop loss is 20 pips and your take profit is 40 pips, that means the risk to reward ratio is ratio 1 to 2. You can calculate RR. RR is also called risk to reward by dividing your take profit by your stop loss. So 40 is your take profit, 40 pips is your take profit, 20 pips is your stop loss. That means ratio 1 to 2. That means for every $1 you risk, you are aiming to make $2 basically. So that means that okay, if you're entering a trade now and you're like, okay, this trade I don't want to lose more than $500, and you've set your stop loss, you set everything to make sure that you don't lose more than $500. $500 is how much you are risking, right? And your let's say your risk to reward is 1 to 2. That means if you are risking $500, you want to make $1,000 from that trade, right? Exactly, simple logic. So another example, I give another example here. Let's say you have a 50 pips stop loss and you have a 150 pips take profit. If you do the division, your risk to reward is 1 to 3. So I think that um if you don't understand what I just, you can just put it on the chat box. If you don't understand what I just explained, you can just put it on the chat box so that I can see. But if you understand, just send a thumbs up. If you understand perfectly what I just explained, okay, very good. So I will say that people are following and they understand it. It's a very easy concept. It's not difficult at all. As regards risk to reward, it's not a difficult concept in any way. So yeah. So now back to lot size. Why does lot size matter? Now let's say you and your friend, let's name the friend Joseph, right? Now your friend Joseph, you take the exact trade. Your account balance is $10,000. Joseph account balance is $10,000. Your entry is the same entry. Your stop loss is the same stop loss. Your take profit is the same take profit. Your risk to reward is the same thing. How come me I'm not making more money than what the fuck is this, man? Me I'm not making more money than Joseph. Same Joseph that we enter the same trade. Like how come that Joseph is making more money than me, or I'm making more money than, okay, let's just say Joseph is making more money than me. We enter this trade together now. My own is reading $2. Joseph's own is reading $4. Like why is it like that? What determines that is your lot size. What determines that is your lot size. So we have three major types of lot sizes, right? We have the standard lot, the mini lot, and the micro lot. So the standard lot starts from 1.0, and 1.0 for the value per pip is $10 per pip movement. Now listen to me very, very carefully and listen to what I'm about to explain. I'm going to take every bit of my time to explain it properly, right? So a standard lot size means that you are entering that trade with anything up, everything from 1.00 lot size. That means that for every pip movement, right, for or against you, you will be making or losing $10, right? And for every for every pip movement, you'll be making or losing $10, right? Now for mini lot is anything from 0.10. That means you'll be making or losing $1. The micro lot obviously 0.01, anything from 1 cent per pip movement. So that means that if you enter a trade now in a certain price, right? You know what? I want to open a demo account, but like I don't even know how I can like show my screen, like my screen for my phone. My phone would have been the best way to do this. Uh, okay, you know what? You know what's going to happen. I'm just going to. I'm just going to. Sorry about that. I'm going to open a demo account. Hmm. I can't open a demo account. Why is that? Interesting. Anyways, I wanted to like do a very short video. Okay, I was you know what? I will send the video to the group. I'll send the video to the group. Let me use this other phone. I'm still here. Just give me a couple of minutes. I'm still here. Oh. I want to quickly open a demo account so that I can show you. I can show you a live. Oh, okay. I was thinking that they will have I was thinking that they will have crypto because I know that crypto is always open. Crypto market is always open, but the account does not have a crypto. Anyways, back to our back to our conversation. So back to our conversation. So now it's like when you enter into a trade, right? You enter the trade with the lot size, right? And the lot size, after you have done your calculation and everything, you determine like how much you make and then how much you lose, right? So let me share my trading view and let's do something very I want to make sure that when you leave this class you understand what lot size is for present. Why can't I present something else? So yeah, if you can see my screen, just thumbs up. Okay, perfect. So now this is the Euro USD chart, right? This is the Euro USD chart. Let's assume that I've done my analysis and everything, and I expect that price is going to reach up here. And I expect that price is going to reach up here, right? Where is my okay? Long position. Long also means buying, while short means selling. For those that don't know, you can write that down. So let's just say I want to buy up here. This current candle, this last candle is where price currently is, and then I put my entry there. I put my stop loss here. Now my stop loss is you can look here, you can see the value of my stop loss. But let me just um I will edit it, don't worry. Here you can see the risk to reward ratio, right? Risk to reward 2.21. My stop loss is around 81.8 pips, and my take profit is around 180.7 pips. But just to make it less, so all this trading view already even does the calculation for risk to reward for you. You don't have to rack your brain around it. But let's now say if you have a 50 pip stop loss, so you see now we have a 50 pip stop loss from the entry. and 100 pips take profit. What's the risk to reward? 1 to 2. So they already do that calculation for you, right? Now the current price of Euro USD, so the market is closed right now. So the current price of Euro USD is one is this green one here. You can see Euro USD written on it. 1.1399966. So let's assume that the current price is our entry. Our entry there. Okay. The current price is our entry. And now we have put our stop loss at 50 pips, right? And then our take profit is at 100 pips based on our calculation. Now, the idea is very simple. Stop loss is the stop loss tool literally means that when price gets to this point, when price gets to this point, that means my analysis was wrong and I want the market to take me out of the trade, right? My analysis was that means okay, for instance, now what's wrong with my network? Okay. For instance, now, if you look at this, if you look at this trade, for instance, now I said I want to buy. Abi, good. And then I put my stop loss here. That means if price gets here, that means price was selling, and that means my analysis was wrong. I'm just using this as an example. That's the idea of having a stop loss. Having a stop loss is very good because you cannot be right all the time, right? So you have to understand that okay, where will the market get to invalidate my idea, right? Where is the market going to get to be like so I can be like, oh, okay, I guess I was wrong, my analysis was wrong. Let me take a step backward, right? But then you are forgetting that as your analysis is wrong, you are also losing money, right? So you have to be like, okay, yes, this is where I expect that my analysis will be wrong. But even when it gets there, I don't want to lose more than so amount of money. Now, this is where some bit of maths enters into it. So we have a 50p stop loss, right? So the idea is that when price hits 50 pips, you don't want to lose a certain amount of money. Now, let's not forget that our capital or our equity is also the same thing as capital for those that don't know that. Our equity is $10,000, right? And now you've done your analysis, you're a very conservative trader. You're like, okay, whatever happens, I don't want to lose more than 1% of this $10,000. So 1% of $10,000, if I'm not mistaken, should be $100. So 1% of 10K is $100, right? So now that you have entered this trade now, you're like, okay, I've put my stop loss at 50 pips, right? If the thing goes 50 pips against me, that means my idea was wrong. I've done my analysis, my idea is wrong. So I've done my analysis. If it gets here, my idea is wrong, but I do not want to lose more than $100, which is my risk, right? I do not want to lose more than $100. So you're going to have to calculate. You're going to have to calculate your lot size, right? Because you're forgetting that it's lot size that determines is your lot size that determines how much you are making and how much you are losing, right? If it's complex, just please share screen, sir. If you're not seeing my screen, just put a thumbs up. If you cannot see my screen, put a thumbs up. Okay. I'm sure you can see my screen though. But if you can see my screen, if you can see what's there now, put a thumbs up. I mean, people can see my screen. If you have anything to say, please just put it in the chat box. I will get it. You can't hear me clearly. That's most likely your network. If you can't hear me clearly, that's most likely your network. If you can't also see my screen, that's most likely your network. Because most other people can see my screen. But let me pin it. It's pinned, apparently. So if you can't see it, it's most likely your network. But I'll send the recording anyway. So but if you're understanding what I've been saying so far, just thumbs up if you are understanding what I'm saying. If what I'm saying is making sense. Okay, very good. I just want to be sure that you guys are understanding what I'm saying. So back to now I have a $10,000 account. I don't want to risk more than 1% of that $10,000, which is $100, right? And then my stop loss is based on my analysis, my stop loss is $50. It's 50 pips, sorry. So your question now will be, what loss size would I enter this trade with that will make me lose only $100 if it gets to 50 pips against me? Let me say that very slowly. The next question you are going to do is determine what lot size you are going to enter the trade with that would make sure that if the trade goes 50 pips against you, you will lose only $100. Now, how do you calculate that? Very, very simple. Come, give me a minute. Very, very simple. So what you're going to do is you're going to do very simple maths. You calculate that $100 divided by 50 pips stop loss. Follow this math. So take your time and follow the math. $100, that's your risk. Okay, let me put it this way. Risk divided by SL in pips. So $100 divided by your stop loss should give you $2 or should give you two. Your answer is two, right? Now, your answer is two does not mean that your lot size is 2.0. That means that, and I'm taking my time to properly explain this. That means that for every pip movement against you, your account must be reading -$2. That means for every pip movement against you or for you, it must be $2. Sure you get. So that means that if his price is good from when you enter the trade, if price goes against you 1 pip, you are losing $2. 2 pips, $4. 3 pips, sure you get $6. Like that, like that, like that, like that. When it gets to 50 pips, it will be $100. And the price will take you out of the trade. But like your analysis is wrong, price has taken you out of the trade. Right? Now, don't forget our discussion on pips. On lot size. Don't forget our discussion on lot size. Remember that I said that this is the three types of lot sizing that we have. So if you are expecting that price you should be moving $2 per pip, you are going to be using mini lot size. Your lot size to enter that trade will be 0.20. That will be $2 per pip, right? It will be 0.20. That means every single pip that price moves for or against you, you'll be losing or making $2. Now, back to the chart. I hope you guys are seeing this standard lot properly. And this is, you can take a screenshot, you can write it down, whatever. I think writing it down would be better. But you can just sharply take this. Now let's go back to the charts. I don't know why it's not letting me just switch tabs. Now, if you go back to the chart, you can see what I'm saying. Now, are they Ade is a wise trader. Joseph is a foolish trader. Joseph is a foolish trader. Now, this same trade, right? If it's that Joseph entered this trade, okay, before I get to that place, now our take profit is 100 pips, right? And we're using 0.2, which is $2 per pip movement, right? Which is $2 per pip movement. That means if price gets to our take profit, which is $100, we'll be making how much? $200. I mean, it's very basic logic. And if the trade goes against us, we'll be losing only $100. Now I want to before I after I'm done explaining this Ade and Joseph thing, I will now explain to you the mathematics behind trading, right? And why why things like, oh, Forex go send you go village, they're always they're always very, ignorant perspectives. Anyways, so back to what I was saying. Now Ade is a wise trader. Ade has a $10,000 account. Joseph also has a $10,000 account, right? But Ade understands that sometimes losses happen in trading. Joseph knows that sometimes losses happen, but Joseph is not thinking about the losses. Joseph is thinking about the wins. So now Ade enters this same trade and risking only 1% of his account. That's $100 or $100, right? And he takes a loss. Oh, Ade comes back from class or is in class, checks his phone, sees that price has hit his stop loss. He was wrong. He loses only $100. We go again tomorrow, right? Now, Joseph, on the other hand, did the same analysis, but instead of entering this trade with $2 and with 0.2 lot size, he entered with standard lot 2.0. Now, the trade that is supposed to be reading, listen, no, the trade that is supposed to be reading $2 for every move against him, or -2, right? For every move against him, is now going to be reading -20. Because if you remember, standard lot is 1.0, starting from 1.0, which will mean that standard lot, let me type that down so that standard lot 1.0 will be equals to $10 per pip movement. Pip movement. Things like 2.0 will be equals to $2 per pip movement, right? I just make sure that you guys are understanding what I'm saying. Let's do something more complex. 2.5 will be what? Sorry, that my $20 per pip movement. 2.5 will be what? $25 per pip movement, right? Joseph now enter this trade with 2.0. As per they think I'm saying, Omo, if this thing knock my take profit like this, you know how much that will be? Eh? You know how much that will be? Calculate am now. 20 times 100. Omo, that's $2,000. Omo, that's only what Joseph is thinking about. The potential upside, right? He's not thinking about the fact that what happens if I lose this trade? He's not thinking about that. He's not thinking about the fact that, oh, what happens if I lose this trade? Now, Ade is in class. Joseph is also in the same class. Now, Ade has lost just $100. How much do you think Joseph will have lost on this trade? Let me throw the question out there. Put it on the chat box. How much do you think Joseph will have lost on the trade? Yes, black beauty. Yes, 0.2 is going to be the lot size. Yes, exactly. For those guys that are following. Yes, exactly. Now, Joseph is going to lose $1,000 on that trade. $1,000 on that trade. Do you know how crazy that is? Out of $10,000, you have already lost $1,000. How much is remaining? $9,000. But for somebody like Ade, who is Ade is the wise guy, he has lost just $100 on the trade, right? How much does he have left now? He has $9,900 to fight another day. Now Ade just has $9,000 to fight another day. Do you get what I'm saying? So now, in a situation whereby, what happens when you now take 10 losses? What happens when you take five? What happens when you take 10 losses in a row? What happens when you take 15 losses? Because I mean, for people that are beginners, I don't know what they are doing. 10 losses is very, very easy. It's the easiest thing in this forex market. So you get, they don't think about the downside. In trading, the downside is the is the most important thing. The protecting your downside is the most important thing. Now imagine if you can't hear anything, that has to be your network. Now imagine a situation whereby Joseph is now is an emotional trader. He takes a loss. Instead of him closing his laptop and going to fight another day, he enters again. He enters again and again. Before you know it, he has lost $3,000 in one day out of 10K. It's remaining only 7,000. How many days do you think it will take him to blow the whole account? But now, Ade is a wise trader. Here's what Ade will do. Ade understands the mathematics. Let me clean all of this up. Ade understands the mathematics of risk to reward, right? And here, just listen to me very carefully because this is where things get very interesting. Ade understands the mathematics of risk to reward. If your risk to reward is, I'm coming, give me a minute. If your risk to reward is 1 to 2, which is a very fair risk to reward, I recommend that if you are trading, let your risk to reward be at least 1 to 2, right? Because of what I'm about to explain now. If your risk to reward is 1 to 2, that means if you risk $1, you are making $2, right? If you risk $2, you are making $4. If you risk $50, you are making $100. Like that. Now, with this mathematics, right, or with this logic, if you take 10 trades in a row, if you take 10 trades, how many trades do you think you need, right, to be profitable? How many trades do you think you need to be profitable? So let's say you take trade one. Let's say trade one is a win. Trade one is a win. Trade two is a loss. Sorry, trade one is a win. Trade two is a loss. Trade three is a loss. Trade four is a loss. Trade five is a win. Trade six is a loss. Trade seven is a win. Trade eight is a loss. Trade nine is a win. And the last trade is a win. That 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, very good. 1, 2, 3, 4, 5. Now we have 5 wins, 5 losses, right? 5 wins, 5 losses, Abby. Let's now say that for every win, every trade you are risking $50, and your risk to reward is 1 to 2. That means that for every time you win, you make $100. So let's calculate. $100 win plus another $100 win plus another $100 win. plus another $100 win plus another $100 win. So you have 5 wins, right? That would be $500, right? And now the same thing for the loss. Every time you lose just $50, right? So that would be $50 loss plus another $50 loss plus another $50 loss plus another $50 loss plus another $50 loss. Now for all your wins, you made what? $500. And for all your losses, you've lost what? $250. At the end of the month, you are left with $250. Are you profitable or you are not profitable? That's the logic. Are you profitable at the end of the day or you are not profitable? But now here's the thing. That will mean that that will mean that your risk is consistent and your risk to reward is consistent for you to have this kind of performance. In fact, if you win only 3 times, that would be $300. If you win only 3 times, say you took 10 trades in a month and you won only three, you will be up $300. And you lost how many? Um, you lost seven, right? If I'm not mistaken. Yes, you lost seven. That would be 350. You will just be negative $50. So let's just say that if you do the mathematics, you probably need only four winning trades that month to be profitable. If I'm not mistaken. 6 times. Exactly. So you probably need only four winning trades that month to be profitable. So when you see traders that be like, okay, they have very like low win rates. It doesn't matter. The win rate doesn't matter if your what do you call it, if your risk to reward is enough to take on that body, right? The win rate doesn't matter if the win rate doesn't matter if your risk to reward can take up the body. And now that is just for people that are trading 1 to 2. There are still traders that they trade 1 to 3. There are traders that trade 1 to 4. There are traders that trade 1 to 5. Now, for somebody that is trading 1 to 5, he probably needs only like 2 winning trades out of 10. Do you see like how meaningful this like risk reward makes trading look? Because everybody feels like, oh, okay, if you're a trader, or not everybody, but like the ignorant ones feel that if you're a trader, you're supposed to be winning now. So I go to lose. I have a private group where I drop analysis and share most of my trades, right? Sometimes I can go 2 weeks dropping losing trades. If it's not your first time when you don't enter that group, you probably think that this man doesn't even know what he's doing. And that's the truth. You cannot win every day in this market. You cannot win every day, right? But as you grow older, as you get more experience, you know how to keep reducing your losses, keep reducing your losses, keep reducing your losses, right? That's the idea. The idea is to perfect your skill to the point that you know you reduce the amount of losses that you can take, and you have better risk to reward, and things like that. Then you can grow your capital, right? So it's like this is just the backbone of what trading entails, right? It's all a mathematical approach. It's all risk to reward. That's the truth. It's all risk to reward. If I check my trading journal now, there are months that I would have loved to show you my trading journal, but I don't think I want to do that. Okay, I think I can show you my Notion. I think I can show you my notion. But I don't put the figures on my notion. Oh, entire screen. Okay. Trade journal. See, somehow, I've always ended the month positive, right? Okay, Monday, January was a very good month. I had a lot of winning days in January. Let's see February. Look at February, for instance. I had one, two, three, four, five, six trading days in the entirety of February, and I only won two, and I lost four. But I still ended the month profitable because why? Risk to reward. There are some trades that I took in this month that probably was like 1 to 3, 1 to 3.5, 1 to 4, 1 to 4. You get that will make you stay. Let me see if the risk reward of this one is here. That will make you stay positive, regardless of your losses, right? Let's see March. Okay, March was a pretty fair month. I had only one loss. I had one break-even day, and I had two wins. So obviously, that was also a profitable month. Look at a month like April too. I had how many trading days in April? One, two, three, four, five, six, seven. 7 trading days in April, and I had only two wins. And then one, two, three, and then four losses. But I still ended the most profitable. April too, same thing. Okay, April I had more winning days, sure. But at the end of the day, I still stay profitable. So I haven't had a negative month so far this year. Why? Risk to reward. I don't know if you guys can see. I hope you can see my. But if you can see, if you saw the notion I just shared, just thumbs up. Okay, I wanted to be sure that you guys saw what I shared. So yeah, and now there's June. Still haven't done my journal for June yet. But I took a trade last week. It was a winning trade. So I will journal that later in the evening. Right? So that's the whole idea of the mathematics that is that goes beyond trade. Okay, somebody's asking me why does everybody not trade? Why does everybody not trade 1 to 5 weeks to reward? It depends. And as we keep going, you understand what I mean by it depends. Because it depends on especially like how much you're willing to wait for a trade. Let me give you an example. Let me give you an example. So I hope this thing can go back as far back as I want to show you something. I'm coming. Just give me a minute. Okay, very good. Let me share my let me share my chart with you. Now, look at this trade. I took this trade last week, right? Here was my entry. Here is my stop loss. I think I took the trade on the 1 hour time frame. Okay, very good. Right? And then my initial target was right up here. Look at the risk to reward. The risk to reward is 1 to 3, right? And I think I posted this on my status for those that have my number. Right? I entered the trade here. This is my stop loss, right? And this is my target here. When the price got here, somewhere here, I left the trade. I left the trade at this exact top. That was really funny, but I left the trade at this exact top, right? Why? Because first of all, I was comfortable with the profit that I had made, and secondly, we were heading into the weekend, and we're heading into non-farm payrolls, which I think I talked about in the last class. It's a news event, non-farm payroll. So I didn't want to be in any trade by the time non-farm payroll hits. Now look at what this trade did. It literally just reversed. Now imagine I kept holding the trade till it got here just because I want to make one to three risks to reward. It will have, price will have gotten this high. I would have been very happy that more price will go my favor. Just to come back and see what that price has gone back into my. In fact, price is now in a losing. I'm not in a losing position. Do you get? So that's exactly why most people don't always hold for very, very much risk to reward. But some people that are very good, they know what they are doing, they they hold on to it like that. But sometimes one to two, most times I'm always out of the trade. Or it depends. Sometimes my trade might not even do 1 to 2, maybe 1 to 1 or 1 to 5, 1 to 1.5. It just depends on a lot of things. Like I do not like I do not like being in a trade on Fridays. I hate having to be in a trade on Fridays. I hate having to be at the mercy of Friday's price action because Fridays just do very unimaginable things. And I don't like Fridays because if I take a loss on Friday, I have to sit with that loss throughout the entire weekend, and I don't like to do that. So if I want to take a loss, I want my loss to be Thursday, Wednesday. I will have forgotten about the loss by Friday. But if it's on Friday, I'll just be waiting for the market to open. So there's a very big possibility that I will do nonsense on Monday. So things like that. So when I see that the trade has gone to a point where okay, I think I'm satisfied with this profit, I just leave. To be very honest, I just leave for my own sanity and for my own peace of mind, things like that. But my basic risk to reward is 1 to 2. 1 to 2 is my risk to reward. So yes, I think we're going to end here for today. I have an event to attend to at ABH, and I also have to sort out my life for the new week ahead. So I'm very glad that I was able to talk about lot size today. I will send you a screen recording. I will send a screen recording to the group that explains, how trades are entered with lot size. Sure you get. I will send it and how the thing they always read. I will send it to you. So okay, yes, another thing I said I was going to address was the question of capital. And I get this question a lot. But too many flies are already entering. My door is open. Come. And I get this question a lot. And I think it's one of the most interesting questions that would I say mentors? I wouldn't really say mentors, but people that do mentorship get. Oh, how much do I need to start? How do I get capital? I always think those are very unimportant questions. For instance, why do I say that? Let's assume you are learning how to, let's say you're learning photography, for instance, right? You're learning photography. Nobody will be asking when you're learning photography, nobody will be asking how much I go need to get camera or how much my clients go to pay me. Nobody asks those questions. You focus on the skill first. All those things you figure out themselves. Because once you're a very good photographer, right? Once you're a very good photographer, even if you borrow camera, your first camera, you borrow them to snap picture. Once you start delivering results, you start making money enough to afford your own camera, right? So the question about capital is always a very interesting question, as I said, because focus on learning the skill. The capital is the easiest part. I promise you. Now, prop firms exist. Proprietary firms exist. For those that don't know what prop firms are, I will send something like that. I'll send it to the group. I'll send it to the group. For instance, I started a company with my friends, Acetrove. I started Acetrove with my friends, and Acetrove is a proprietary firm, right? Its job are not just on a large scale yet. So what does a proprietary firm do? A proprietary firm funds traders. Okay, you can prove to us that you can trade. That's very good. That's very nice. We love the idea of that. Can we see any proof to that effect? You show it to us. Okay. Now from the company's fund, we will offer you a certain amount of money. Let's say we can offer you $10,000, $5,000 to trade. You make your return on that money, and then the company takes a share, the trader takes a share, But at the end of the day, you still also have your base salary that you collect every month. So all those things like that exist, right? And then you can also do like individual pitch or decide to grow your own personal money. But prop firms are like the easiest, they are the easiest entry into this space, right? There's always there are always people that are willing to fund you. There are always firms that are willing to fund you as far as you can prove to them that you can trade, you can prove to them that you can manage risk, you can prove to them that you can make money, you can prove to them that you can do it consistently, right? Those are things that matter. So my advice for you is that forget about how much you need to start. It's very unimportant because if you have the money to start right now, you are not going to use the money to do anything productive. You are going to waste the money because you don't know what to do. You don't know how to trade. What currency pairs do I trade? I trade just Euro USD and GU once in a while. Yeah, so that's that about capital. So focus on what's it called now? Focus on learning the skill. Focus on growing it. Focus on perfecting it. Focus on mastery. Capital is the least. I promise you, capital is the least. Another question. I want to reduce my risk from my RR from 1.1 to 5 to 1 to 2 and take two trades instead of taking up to 5 per week. First of all, I don't know how you're taking 5 trades per week. But at most, I take one. Sorry, at most, I take two. But most times, I take one. Just one trade per week, right? Because there are a lot of things that, but as we get there, you understand why. Does this guarantee that I should risk more of my accounts? What's the point? What's the point? Taking more trades, risking less, taking less trade, risking more. What's the point? You're really just doing the same thing all over again. What I would advise you is that take your time to understand your model, understand what works for you. If you are going to reduce your the amount of trades you take every week, if you are going to if you are going to reduce the amount of trades that you take every week, then what is your rationale for that, right? And then everything boils down to risk. Everything boils down to risk. So don't start risking more of your account if you've not gained consistency. It's consistency that determines whether you have to increase your risk or not. Like for instance, now when I started trading for prop firms, when I started trading with prop firms, I used to risk 0.5. When I got funded, I used to risk 0.5. 1 to 2 risks to reward. I used to make 1%. But then as I started getting more conversant with my model, I started getting more confident in my model, started getting knowing what I was doing more. I increased my risk to 1%. Throughout the entirety of last year, I was risking 1%. And as I started getting more confident as well, I risk 2% of my account. I risk 2% of my account. So and that's because I can do that because I'm confident about okay, even if I take a loss, I'll make it back. Doesn't really matter. Um, from those firms, do you still receive your salary no matter how much you? No, for the profit kind of profit that I trade with, no, I do not receive a salary. It's just performance fees. They pay me based on what I make. Which time frame do I use the most? Hmm. I use from the daily. I use different time frames for different purposes, right? I do my analysis on the weekly and the daily time frame, right? And then I also do analysis on the 4 hour time frame. I take most of my trades on the 1 hour time frame, 1 hour 15 minutes time frame. Does leverage affect risk to reward? No, leverage does not affect risk to reward. I'm coming. Yeah, so yes, I mean that's what I explained from the beginning. The higher the lot size, the more you lose and the more you make. Do you have to consider leverage when calculating risk to reward? No, risk to reward has nothing to do with leverage. Why is it easier or better to do analysis on TradingView than on MetaTrader 5? It's easier because I mean TradingView is like a cleaner platform. You can use it on your laptop, so you get for wider view and things like that. So yeah, it's just better to use TradingView, I guess. But for executing, MetaTrader is fast because the software also is like very responsive. ASAP, ASAP, ASAP. And you get so any more questions? What are trading signals? Trading signals are when someone does an analysis and sends it out for people to enter a trade. So you basically don't have to do anything, just impute whatever the person sends to you. I would never advise trading signals though. They make you lazy, you lose a lot of money. And yeah, let me just put it that way. Will you be getting a pick at your strategy? I don't have a strategy. I have models. And yes, obviously, my model is like very easily explainable. But if I'm explaining it to you, you probably have some experience trading. It's not something that I can explain to a beginner. That's why I'm taking you guys through all this process. Then eventually I'll tell you what my model is when you have better understanding of things like fair value gap, things like order blocks, things like time frame alignment. But we are getting there slowly but surely. What else? Trading signals are similar to copy trading, right? Yeah, something like that. Very similar. Similar jargons, similar nonsense. Um, I'm guessing that's all. Yeah. How does one pay profits back? Pay profits back. You don't pay them back. They pay you. Is there a reason why I like the Euro USD? Yes, I like it because I know it's like the back of my palm. I've traded it for like 4 years. I mean, let me check my journal. 1, 2, 3, 4. Yeah, I've traded it for like let's just say 5 years. So I know it's like the back of my palm. And if it makes money, why go to another pro? Am I going to sell a course to you? No, I don't sell courses. I do mentorship and it's free. So make the best use of it. Uh, do I hang up this call now or you know what? Let's continue the rest of the conversation. Let's continue the rest of the conversation on the WhatsApp group. So I'll open the group for a couple of minutes so I can answer any other questions that are left. I think that's good. So good night. Have a very lovely week. I hope you're able to get a lot of value today. If you understood everything that I explained today, just let me see like thumbs up. I should add you to the group. I posted that group link like 400 million times, but I would just post the link on my status again. I'll post the link on my status again. So yeah, I'm very I'm very happy for everybody that joined today, and I'm glad I was able to provide a lot of value to you guys. So have a lovely week ahead and consume, 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 consume. Keep consuming a lot of value. All right, bye. Good night. Oh, I'm recording. Recording in progress.